we're obviously looking at MayJune 2017. 2-hour paper, 70 marks. Again, you obviously need to look at your strengths. Start with the long questions if you feel confident enough to answer them without having to spend too much time going through the long questions, because that does count 30 marks out of the 70, which is a lot. You can't pass using the long questions, but it's definitely going to add to the overall average, obviously. Okay, so depending on your strategy, either or works. Last time we looked at long questions first, then we went to multiple choice. It doesn't really matter, it's up to you. As long as you've covered both in the time allocated, you'll be okay. Right, so number 1 is pure theory. Which of the following would be best considered as a principal agent problem, okay, in favor or looking at the behavior of the different managers? Okay, so remember, when looking at the principal agent problem, we're always looking at something that's going to benefit the one party and the business will lose out, okay, in terms of their benefit. Okay, so Ethan chooses to pursue a risky investment for the company's fund because his compensation will substantially rise if it succeeds. Definitely. Okay, there's the element of self-interest there. Okay, you chose 1 as well. Good. Okay, number 2, which of the following should be the primary goal pursued by the financial manager of a company? So primary means creating that value. Okay, remember, profit is a byproduct of creating enough value where you've got more income than expenses, but it's not the main objective. To maximize the market value of the company's shares, book value, dividends, no. Okay, market value would be the best one because that would be the shareholders' ownership, basically. Okay. Okay, number 3, which one of the following statements about the company form of business organization is incorrect? Okay, so we're looking at one that's false. The shareholders of a company have limited liability. That's correct. The company is the easiest form of business. No. Okay, the easiest would be sole proprietor. Exactly. Companies are typically larger than partnerships. Yes. Generate significantly higher percentage of total annual sales. Yes. Okay, so the one that's out is 2. Good. Which of the following would not be considered a secondary market transaction? Okay, remember you get primary markets and secondary markets. Just to revise a bit of theory, primary is when big banks buy equity directly into those companies before they then trade those shares on the JSE. Okay, remember secondary market, the best example to remember here is just the JSE. Sony issues new ordinary shares using its investment bank. That's primary. An institutional investor sells some BLC shares through his broker. It's institutional. So because I see the word institutional, that tells me that's looking at big business, so direct. So to me, through his broker. If it's through a broker, it is on the market. So it's possible, but not perfect. Let's just see what else we've got. Pilgrim Corporation is trading funds and issue shares in the market. Okay, their trade is trading funds and issuing shares in the market. So because the word issuing here, issuing to me means IPO, okay, or issuing new shares, okay, not the ones that are existing. Okay, remember, when you see the word issuing, you're always putting out more equity. Right, so to me that would also be primary. We're looking at which would not be considered a secondary market transaction. Okay, which would not. So we're looking for the one that's not secondary. Be 1 then, basically. But let's just check. An individual investor purchases some existing shares of a broker is there. So if it's a broker, that means that it's been issued. We're not looking at new. So the key word here would be this, new. Okay, so I'll be looking at new ordinary shares. New meaning IPO, first issuing shares. Right, which is primary, and definitely you've got the investment bank. Okay, we've got ratios. Okay, so here they've started with ratios in this question. We've got P. Okay, they have current assets of that, current liabilities of that, and they've got cost of goods sold of 1.2 at the end of the year. If P had a quick ratio, right? So quick ratio in inventory turnover. So
it's assets minus inventory over current
Yeah, so let's just put the quick ratio first. So quick ratio equals bracket CA minus inventory over current liabilities. Correct. Okay. Then you need another one. Inventory turnover. Okay, that one I think is okay, those formulas again. Yeah, this week I'd be studying them for Monday, because if you're writing on Monday, you're going to need to know them.
No, I will.
It's going to be quite difficult to remember all of them in a short space of time. So I would start looking at them. I'd be trying to do past papers without my notes, without my formulas, in order to try get the right answer. And then if I get stuck, I will do it afterwards and then make a mental note. Okay, well, this formula I need to study because I don't know, or I need to know. Okay, it's not liquidity, it's the next one there. Inventory, yeah, it was cost of goods or sale, yeah, over inventory, so that was fine. Okay, let's just copy these formulas. Just paste it there. Right, so now that we've got that, we can just insert the values from the question. The first amount that they said was current assets, so 950
minus.
Okay, so we know that the current liabilities is
minus
450.
No, that's current liabilities.
Yeah, so divide by current liabilities.
Oh, I thought you were putting inventory as
No, I'm not putting in inventory, I'm just putting in what we know.
Yeah, no,
okay, so the what we know is given in the question. Yes. Cost of goods sold 1.2 million. Yes. Quick ratio 1.56. Okay, then you've got IT, inventory turnover, equals cost of goods sold 1.2 million.
Yes. Over inventory.
Yeah, which you'll need to work out from here.
So obviously we've got more information there, so we had start there.
Exactly. Solve for inventory. Alright, so that's good. 1.56 times 450, close brackets. If I take that across, it'll be minus, that's fine, or if that goes across, that'll go there, and it'll be, let's do it the other way, because I want positive inventory. Let me put more steps just so that you've got it in case. Okay, so copy paste times 450,000. Right, so 1.56 times 450. Okay, equals 950, yeah. Okay, and then less inventory. And then obviously solve for inventory. Take that side, that side. So inventory equals 95000 minus that figure there. Okay, 248. So inventory turnover is 1.2 million divided by 248, which is, which option did you get?
I got option 4, 4.8.
4.83, yes. Okay, so 4.8 is correct. Option 4. Good. Okay, so.
But if we did it the other way, where we said 1.56 times 450 minus 950, you're going to get the same answer.
Yeah, but it'll be a negative.
But you'll
yeah,
just know.
so I just wanted to use the right sign, okay, just to make sure that The maths is correct. Okay. Right, H has a return on assets of that. When I see return on assets, I'm thinking DuPont. Okay. Total assets for the year, that. And the shareholders' equity of that. What is the return on equity? Okay, so because they don't give you enough information regarding DuPont, I'm not going to use DuPont unnecessarily. Okay, so return on assets is a formula. We need that formula. There we go. And we need ROE as well. We need these two. Okay, so let's copy both. Okay, so those are the two equations. Right, what did the question give us? Let's see. Return on assets, 6%. Total assets, 3.5 million. Okay, so 6% equal profit for the year divided by, what is the amount again? 3.5.
3.5 million, yeah.
Okay, 3.5 million. And the ROA was 6%. Okay, then they gave you ordinary.
Equity was 1.5 million.
Yeah, so profit here divided by 1.5
million.
Okay, there we go, that's it. Right, so obviously solve for profit first. If I solve for profit, I'm going to get 3.5 times 6%. Okay, 210. Alright, so ROE is 210 less or divide by that times 100. So ROE equals 14. Well, if you times it by 100 to get a percentage. Let's just check if there's no other decimals there.
There isn't.
Okay, there isn't. Okay, so it's a nice round figure. 14%. Option 3. Okay, we're getting them right, eh? That's good. Okay, 7. Let's see what 7 wants us to calculate. Okay, F has reported a debt ratio. That's important. Total liabilities 360. Companies had sales of that, and they want total asset turnover. So debt ratio and total asset turnover. Okay, and then we have total asset turnover, TAT. TAT, I think, is sales over total assets. Let's just check. Instead of having to copy the formula, yes, sales over total assets. Okay, so it's turnover, so sales over assets. Alright, so now that you've got that, we can work it out. Okay, debt ratio 60%, liabilities 360. So 60% or 0.06 360,000 divided by total assets. Okay, total asset turnover, we don't know. They want it, but they gave us sales of 472.
500.
Okay, 472,500 divided by total assets. Right, so you'd work out the total assets first. So TA equals that divided by 60%. Okay, because
How can you divide it?
the TA goes to the left, it becomes times.
Okay.
That divide.
So if you take that to that side.
What to what side?
360,000 to the 60% side.
But you've got, if you take that across, then you've got 1 over TA on the right. That's still a fraction. Okay, so if you take this to that side, it'll be divided by 360, but then you're left with 1 over TA. Okay, so be careful of fractions. Okay, you don't want the denominator, you want the numerator. So take it that side. Okay, so if I take it that side, it becomes times. If I take that side, it becomes divide. Right, so TA equals, copy, 600,000. Alright, so TAT equals 47200 divided by 600,000 is 0.79 if you round off. Good. Okay, so 2. 80s theory. Which of the following would best explain a situation where a ratio of return on equity, so ROE, of the company is higher than the industry average? This might even be a repeat question.
Yeah.
Okay, higher than the industry, while the ratio return on assets is lower than the industry. So you need these two formulas, ROA and ROE. Copy, paste. Here, obviously ROA is second, and then ROE is first. Okay, so that's what you've got. And this is higher than the industry.
Average, while the ratio of return is lower.
Return on equity is lower.
Yeah.
Okay.
ROA.
ROA, yes.
Yeah.
Okay, so return on equity is higher than the industry. The return on assets is lower.
Yeah.
Good. Okay, the company's debt ratio is higher than the industry average. I think that was the right answer from a previous question.
I got that one.
Okay, so if I paste that there, the debt ratio, total liability, can make equity the subject. O would equal A minus L. Okay, assets minus liabilities. Right, so if they said the debt ratio is higher than the industry average. Okay, so if it's higher, that means you've got more debt, okay, more total liabilities. Okay, if you've got more total liabilities, you'll have less total equity. Okay, so less total equity makes this denominator smaller. If it makes the denominator smaller, the answer is bigger. This won't affect that, okay, because total assets is total assets. So lower than the industry, higher than the industry. Okay, so debt ratio would eliminate or would lower the denominator, which makes the ROE higher.
Yeah.
Okay, so that would be correct, because if that's higher, net profit margin is higher. So if it's net profit margin, ROA equals NPM times TAT. Right, so if the net profit margin is higher, the ROA is higher. That one's out. If total asset is higher, then it's the same thing. It's times. So that one's out. And then financial leverage multiplier is lower. If it's lower than the industry average, then you're multiplying ROE by a smaller amount, which makes this one is correct. Okay, but yeah, if you've done enough past papers, you probably recognize that that's a repeat. Okay. Right, number 9. Last year, M's profit for the year was 2 million. The number of ordinary shares was that, and the PE was that. Market price per ordinary share, so you need those two formulas. Right, so immediately you go to your piece of paper, you jot down these two equations. Okay, well you actually need a few more, because these formulas also use other ratios.
Yeah. Okay,
so I'm jotting all of these down. Price earnings, market to book. With price earnings, I'm also going to need EPS. So, copy, paste. Okay, so now we've got our EPS. Now we've got everything. Right, that's what we've got. Okay, so then we need to insert the values. Alright, so profit for the year was 2 million. Profit for the year, there's profit for the year. So, EPS equals 2 million. Any other profit? No profit, no profit. Fine. Number of ordinary shares, 150. Number of ordinary shares, divide by. What is it? 150.
And isn't it their price per ordinary share as well? PE?
Price per ordinary share, yeah, but that's later on.
Okay.
If they give it to you.
Okay.
They don't give you the price per ordinary share.
No, I just saw ordinary
share
limits.
Price earnings. 12 equals market price divided by EPS. Okay, I don't have the market price, I don't have the EPS, but I can work out EPS. Okay, so I don't actually need the other formulas. I don't actually need the M value. Okay, that's 13.3. Okay, so EPS 13.333. Right, so solve for market price. Market price would then be the 12 multiplied by 12 times that answer. 162. Good, you got it.
Yeah, but where do you see once I'm having a blonde moment?
160. Last question. 9.
Oh, I'm looking at the wrong one. Sorry.
Okay.
I'm like,
Okay. 10. F had a net profit margin, so that's NPM, that you can actually write down. That's profitability. It's this one. Let's copy it, paste it. We're probably going to use it. If not, we'll use DuPont, depending. Okay, because when you see net profit margin, you know it's a DuPont possibility.
yeah.
Okay. Total assets is that. They want to know what is the ROA. Okay, so ROA is what they're asking for. Right, so let's go back and reread and then insert. Okay, so net profit margin 7.1%
Yeah.
equals
Sales is 1.2.
1.2. Sales is 1.2, so it'll be profit over 1.2. Right, so I can solve for profit already.
But it's profit minus share dividend.
Do they give you a share dividend?
No.
No, it's minus
So
0.
it's gonna be 0. Okay.
Okay, so if they don't mention anything
Then
about a
it'll always
dividend,
be 0.
it'll just be 0. Yeah. So 1.2 million times 7%, 7.1%. Okay, gives you that. Right, so ROA equals the profit, 85,200, divided by the total assets of 1.5 million. 1.5 million equals an answer. 5.68%.
Yeah.
Option 2.
Yeah, you have to times by 100 and then you get that.
Good. Okay. Right. F has an interest expense of that, profit for the year of that, and a tax rate of 30%. When I see tax given like this, I know it's EBIT. Okay. Less interest, less tax, well EBT, then less tax, and then it gives you the profit for the year. Okay, so I'll write that down here. But when I see that, that's a clue.
Yeah.
Okay, so that's what I want. Interest expense 15,000, so we can put 15 there. Okay, profit for the year 63, that goes here. What is the company's times interest earned ratio? Okay, so we need to go get that formula. Times interest earned. Where are you? There you. Okay, copy, paste. Alright, so for my times interest earned ratio, I need what? EBIT. I need this. Alright, so you need to work backwards. You've got 63%. Tax, you know, is at what rate? 30%.
30%.
Okay, so if this is 100, you would less 30 and you'd be given 70. Right, so this is what I want. So if I want that, I'm going to take the 63 times it by 100 divided by the 70. Gives me 90,000. Okay, 30% of 90,000 is 27. 90 minus 27, 63. Make sense?
Yes.
Okay, so now that I've got that, earnings before tax, I can add back the interest to get the EBIT. Okay, so TI equals 105, 123 divided by interest of 15 equals.
So you just say 90 plus 15.
Gives you 7. Option 2. Got that one. That one's a bit tricky. Okay, but if you're getting it right, that's good.
To do the less
Correct.
tax and then
Yeah, that's exactly right. You should be using that. Okay.
But this was a tricky one.
12. Let's see. Company has a current ratio of 1. What must the company do in order to improve its liquidity position? So current ratio is looking at anything with current assets. Improve its collection, definitely.
This is an
Increasing
economics.
cash, definitely. Increasing current and quick ratios. Well, increasing those current and quick ratios would increase your overall liquidity, but those are measures. So I don't really like that answer, but we'll keep it in mind. Improve collection, yes. Pay accounts payable. Well, if you pay accounts payable, would that increase your liquidity? It will lower your current liability, so it would. Okay, so CA over CL. Do you agree?
Yeah.
If I pay this, this goes smaller.
Yeah.
That answer gets bigger. So that one's also right. Decreasing current liabilities and increasing the current. Yeah, that's correct. That seems right. Decrease current liabilities, that's correct. By utilizing more long-term debt, thereby increasing the decrease current liabilities. If you decrease current liabilities, you do affect it. Utilizing more, thereby increasing. But you're utilizing more long-term debt, thereby increasing the current and quick ratios. That could be right, but not the best answers. Increase inventory. If I increase inventory, I'm going to reduce my current I'm going to increase current assets, but I'm going to reduce my asset test.
Yeah.
Okay, so that one's out. So best answer would be 2.
3. Wouldn't
No.
it be decrease current liabilities by utilizing?
No, I would go with 2 being the best option. Okay, because you're improving its collection practice. That means you're collecting more.
Okay.
If you improving collection means what? I'm going to be receiving cash sooner rather than later. So that's more cash. That's better liquidity. Okay, if I collect, I don't change my my debtors. I just make my debtors cash. Okay, so the net effect there would have been 0 basically, because your debtors would have gone down, your bank would have gone up. Okay. Pay your accounts payable, thereby decreasing current liabilities. That's correct. If you pay accounts payable, you reduce your current liabilities, which increases your current and quick ratios. Okay, so I would be looking at that better because liquidity is short term. Here they're talking about long term. Okay, so I like 2 better than 3, but 3 is also a possibility. Okay. P has preference share dividends of 80, profit after tax of that, and they generated sales of that. They want the profit margin. Okay, but now which profits? Do they want gross profits? Do they want net profit? Or do they want operating profits? See? The wording's not correct. But this is a giveaway. Profit after tax. If it's profit after tax, then it's net profit. Okay, so they just need to fix up their question. They can't just say profit margin. You've got 3 profit margins. Here they gross profit, operating profit, and net profits. So now we need to know which one. Okay, so a bit of an assumption. If we don't get an answer that's there, then I'll use a different one. Okay, so net profit margin equals profit for the year, which was given in the question as 750, minus the pref div of 80, divided by sales of 10 million. Okay, you type that into your calculator and you get 6.7%, which is there. So that's what they're probably asking you for. Okay. Right, 14. In the process of your financial analysis, you find that a company's total equity was that. Okay. Total liabilities was that. Okay. When you see equity and liabilities together, assets equal what? Equity plus liabilities. Do you agree?
Yeah.
Assets equal O plus L. Basic accounting equation. Right. So I could write down total assets as that amount plus that amount if I need it. Debt ratio of the company, debt ratio there. Okay, see, I need my assets.
Yeah.
Right, so you do actually need that formula. Okay, debt ratio, total assets equal owner's equity plus liabilities. Right, so if I want the assets, I need to add the equity and the liabilities. They gave me the equity, they gave me the liabilities, so I can just insert that. Right, so the debt ratio equals, I don't need to put a bracket here. The current liabilities was how much? 2992. 2992,000.
Yeah.
Okay, divided by total assets will be brackets. 2508000 plus 2992000 close brackets. because of the basic accounting equation. Make sense?
Yes.
Okay, so answer here. There we go. Okay, you can times it by 100 to get the percentage. Option 2. Okay, 15. Assume that you will receive 3,000 in 3,000 per year in years 1, 2, 3. 6,000 in year 4 and year 5. This is cash flow, and you require a return. Okay, so we need to draw up this. Use cash flow. Yeah, just insert that in the calculator so we can check it while I write them down. Y1, Y1, Y2, Y3, Y4, Y5. Okay, so 0. Okay, so you'll receive 3,000 years 1 to 3. So 3,000 there from year 1 to year 3. Year 4, 6, year 5, 9. That's it. The I is 11%. Solve for NPV. Let's just check your inputs. Okay, 16. 16,624.59194. Let's see what you had as your cash. You had 11% in your editor, 0.33369, correct.
And that was still saved from yesterday.
That's good. Alright, so which one's that?
It's 2.
2. Okay, good.
This
16.
is my favorite part.
Yes, time value of money. You should like this because it's quicker, it doesn't require much effort, you just need to identify values. Right, so 16. Mason would like to have 200 in an account for retirement 15 years from now, that's future value. 15 years from now, that's N. How much should be deposited quarterly? Quarterly means times 4.
Yeah.
Account paying 6% compounded quarterly, so I4. I4 is 6%. I4 equals 6% divided by 4. The N equals 15 years times 4. Right, the future value is, what is the future value? 200.
200,000.
Okay, present value equals, we need to solve. Okay, PV brackets, the rates, which is brackets 0.06 divided by 4, close brackets. N is 15 times 4 is 60. No payment. Future value 200,000.
Yeah.
Close brackets. Answer 81,859.
Isn't it
Oh, quarterly. Sorry, payments. They said how much should be deposited quarterly. I'm not solving for PV, I'm solving for PMT.
Yeah, that's what I thought.
Okay, sorry.
Payment.
Let's copy that. Let's just fix it. PMT equals PMT brackets. Okay, rates. Alright, the rate is fine, the N is fine, the present value is fine, the future value is fine. Okay, there's it. Option 1, good.
I thought for a second I did something wrong.
You know, I just read it wrong. Okay. E wishes to buy a house but can only afford monthly payments of that. That's PMT. 30-year loans are available, so 30 years is your N.
Compounded monthly. So
Compounded monthly, so times 12, and that's I12. Okay, if she can make a 5,000 down payment, what is the price of the most expensive house she can afford? Okay, so payment equals 500. 30 years, so N equals 30 times 12. I12 equals, what is the rate here? 6% compounded monthly. Good. Okay, then you are looking for PV. Solve for PV. Let's work that out. PV is, the rate here is bracket 6% divided by 12. Okay, the N is 360 months. The payment is 500.
I got that answer, but it might be wrong because we didn't add
What
the
is the price
5,000.
of the most expensive house she can afford to purchase? Yeah, but this is a negative answer though, hey? That's a bit suspect. Error here. Well, not error, but consideration, because This is a negative answer.
It's actually option 4 because I said option 1, but I didn't include the 5,000.
Yeah, but remember, this example is flawed because this amount is... Oh, actually, it's not flawed. Let me put a minus here. It's correct. Okay. So ignore the negative. If I insert a negative, then you get a positive. Right, then you need to add the deposits.
And that's what I didn't do.
Okay, be careful. The deposit is something to consider because she can afford to buy a more expensive house because she's still going to pay a deposit. Alright, so this plus 5.
It's 88,395.
Yes, which is 4. Okay, so just make a note just so that you don't make the same mistake when they ask you a question similar. And we've always seen a question like that, hey?
It's always in the
Yeah. Okay, perpetuity 75 rand per year at a rate of 6%. That's easy. PV equals PMT divided by rates. PV equals 75 divided by 0.06. Do you agree?
Yeah.
75 is the payment, the rate is 0.06. 1,252. Got that one?
Yep.
Okay. Number 19. You plan to invest in securities that pay 14% compounded annually.
I1.
So that's I. Yeah, I1. How long will it take? So you want N. N is the question mark. To take for your investment of that, which is PV, to grow to that, which is FE.
Yeah.
Okay, so let's write those things down. PV 10,000. FE 20,000. I equals 14%. Solve for N. Let's see what we get. N is rate 0.14. No payment. Present value minus 10,000. Future value plus 20,000. Close brackets. Answer 5.29 years. So option 3. Okay, halfway in terms of multiple choice. Okay, question 20. What is the rate of interest that must be earned for deposits of 500? That's PMT. At the end of each year to accumulate 12,000 FE over N periods. Okay, this is made at the end of each year, so everything is in years. Right, so N equal, we need to solve for N. No, we've got N. N is 10 years.
Solve for R.
Yeah, the payments are 500. Payments 500. And the future value is 12,000. FE 12,000. Right, solve for the rates. Okay, what is the rate of interest? Let's work that out. Equals rate brackets. The N 10. Payments 5,000. 500. Future value 0. Future present value 0. Future value 12,000. Close brackets. Answer 18%.
Yeah.
Let's just see if there's any decimals.
18.41.
Yeah, there are decimals. 18.41 if you round off. Option 1. Okay, question 21. 500,000 rand loan is repaid. That's the PV. It's repaid over N years with equal annual payments. So everything is in years. The interest is 7%, which is I. What is the balance on the loan at the end of year 7? That's an amort. Do you still know how to work out amort?
The amort function,
Yeah, okay, so 500,000 is the PV. Okay, the I here was 7%, it was 10 years. 10 years. You need to solve for PMT first.
Yeah.
Okay. Then you do the amort, correct. Okay, so can you do that in the calculator, just so I can check your input? Okay, payment brackets, the rate 0.07. Okay, N10 PV 500,000. Close brackets gives you a payment. Okay, so step 1 is to calculate that. Right, then step 2, use the amort function. Right, obviously your PM1 is going to be, what is it, 7 year? Yeah, 7 years. Okay, and your PM2 is going to be 7. And you're going to solve for, what is the balance? Solve for balance. What is your balance? 186 821.7824. Okay.
Yeah.
Let's just check your inputs. Let's see them on the calculator. Escape. Your PMs are correct. Your compound interest is 10 for N, 7 for I. Yeah, it's all right. Good. Okay, that's correct. Nice. That was which option?
Option 4.
Option 4. Yes. Okay, 22. Alright, for 3 years, so that's N. Mary deposits that at the beginning, there, begin mode, of each year, so that's the PMT, into an account that earns interest of 4.5% compound semi-annually, that's half yearly. How much will be an account at the end of 3 years? That's N equals 3 times 2. Okay, so N equals 3 times 2 because it's half yearly. The rate here, I, is I2, 4.5% divided by 2. The deposit is 3,000, PMT is 3,000 per, at the beginning, this one's a tricky one. They said beginning of each year. So when are the payments occurring?
Right in the
at the end of each year. So you actually need I1. You can't use I2. Okay, because the payments are at the beginning of every year. Alright, so this is every year, not every half year. Alright, so I need I1, I don't need I2, and I need years. So because I've got that, everything must be in line with the payments per year, because you can't change that. Okay, so let's review. N would then be 3. We need I1. So to get I1, we need to convert I2 to I1, which is that EAR, effective annual interest rates. Okay, so it's the 1 plus IM brackets to the power M. This is just the long formula for it. Where's my that thing, to the M equals brackets 1 plus IN close brackets to the power N. Okay, so if I'm looking for I1, you can just use the EAR straight from the textbook or straight from the formula. I'm just using this. This is how I use, so I don't have to know what that formula is specifically. Okay, so it's 1 plus I1 to the power 1, which leaves it as 1, equals brackets 1 plus I2. I2 is 0.045 divided by 2, close brackets, to the power 2. Okay, squared. Alright, so this I can drop the power 1, so it'll be 1 plus I1 equals. Okay, that I need to work out. So, open brackets. Let's do it in 2 steps. I need to square it. Okay, so let's just do side working here. Right, 1 plus 0.45 divided by 2 is that. Take that and times it by itself is that answer. Okay, so that's what I've got there. Then you minus 1. So I1 equals that minus 1. Okay, as a percentage. Okay, with more decimals. Okay, I would leave as many decimals as possible. So that would be your I1. Your I1 is that answer there. Okay, the payment is per year and use begin mode. Right, so what did they ask for here? How much will be at the end of her account, so future value. Right, so FE is, her rate is that, okay, 3 payment 3,000. No present value, type 1 because it's begin mode. 9844. Not there.
I got 4.
Okay.
19,400.
Yeah, so if it's not there, then I think there's a typo here. I think this should have been semi-annual.
That's how I worked it out.
Yeah, but they didn't say semi-annual. Okay, so we need to review their working. So there's errata here. Beginning of each year is incorrect. It should be beginning of each half year. Alright, so let's try that again. Now we can use this. So assuming there is a payment every half year, then we would keep everything the same. You would just solve for future value. Alright, so future value equals the rate, which is brackets 0.045 divided by 2, close brackets. The N is 6, the payment is 3,000, and it's begin mode, so it's type 1. Okay, 19471, option 4, yes, okay, but see, there's errata here. Beginning of each year, should be beginning of each half year, because that's when you make the payments. Okay, so that's just a problem with the question's wording. Option 4, you can get option 4 having done 2 workings. Okay. 23. J will invest that today. PV. Investment will earn that for 5 years. That's the I, that's the N. No funds withdrawn. How much will the amount be in the fund after the end? Oh, that's easy. Okay, so
Yeah, you need future value.
present value equals
200,000.
200. I equals
6%.
N equals
5 years.
good. Solve for future value. Let's see. FE brackets. The rate 0.06. The N 5. The present value, no payment. Present value 200,000. Close brackets gives you 267.
64512.
Option 2. Good.
Yep.
Okay, 24. You want to have 8,000 in 6 years. Future value N. How much would you have to invest today at a rate of, that's I. That's easy. Solve for present value. Alright, so we've got an I. What is the I?
I is 6.
What is the N?
Sorry, I is 10.
What is the I?
N is 6.
N is 6, okay.
And future value is 8.
8,000.
Yeah.
Okay, 8, 6, 10. Good. Solve for present value. PV brackets, the rate 0.1.
Option 4.
N is 6. No payment. No present value. Oh, future value. That was the right one. Future value 8,000. Option 4. 4515. Correct.
I've only gotten 2 wrong.
Yeah, it's very good. It's looking really good.
Yeah.
Okay, this is theory. Which of the following measures an asset's risk is found by subtracting the pessimistic from the optimistic? That's the range. Highest minus lowest. Correct. 2. Good. 26. Use the following information to calculate the expected return. Okay. You've been, that's all that they've given you. So let's just multiply and add up.
Multiply, yeah.
Exactly. Okay, so probability, return. Right, probability was 0.3, 0.6, 0.1. Okay, return was 0.02, 0.08, 0.10. Okay, so to get the ER calculation, we need to take this and we need to multiply it by that and then do that for each one, then sum up, and the sum is the answer. 6.43. Good. Okay, question 27. Now we're looking for the standard deviation. That requires a table. Okay, so I'm just going to save time and just copy this through to our answer, and then we can use the table to do the working. Okay. Right, so we've got those two. Just delete the other stuff that we don't need. Okay. Great, so let's insert stuff into this table.
There's only two.
Is there only two? Okay, it's a short one. Okay, 30, 70, 2 and 8.
Yeah.
30, 70, 2 and 8. Right, so they want this. Standard deviation 18.35. Assuming that the expected return is 6.2, it is. What is the standard deviation of return? Yeah, this is wrong. Okay. Standard deviation, there's standard deviation.
Yeah. I didn't do the whole thing.
You didn't do the whole thing? Okay, you had to, because you had to get variance. Once you've got variance, you square root the variance to get the standard deviation. Right, so there's a problem with the question. Okay, problem errata.
So, would they give us the mark or would they exclude it?
Yeah, I don't know. In this scenario, it's questionable. Okay, because I've used the right one. Yeah, there's 30, there's 2, there's 70, there's 3. Possible return. Oh, hold on. Oh, I've made a mistake. Wrong way around. Probability, then return. This was return. That's probability. Sorry. I had it the other way around. Okay,
So
copy
it's
paste.
four,
0.3 here, 0.7 there. Oh, okay, it's right. Sorry, I made a mistake. I had this the wrong way around. Okay. Option 2 is correct, yes. Okay, so yeah, just be careful. It's possible return and then probability. Here they gave it to you as probability, then return. Okay, so just insert it correctly. I made a mistake with that. But if I fix it, then I get option 2.
Well, I guessed that one.
Okay.
And I'm not
You
going to
shouldn't be
guess in the
guessing.
exam,
You should be doing the whole table. Okay, but yeah. Lucky guess.
Yeah.
Okay.
No, I won't be guessing the exam, I promise.
You have enough time, so don't
Yeah.
stress. You'll see this week we'll probably finish a bit ahead of time because you've done the whole past paper and you're comfortable doing the workings. Okay,
I
so
get it,
it's looking better now than before. Okay, I'm just going to say here, see table separate worksheets or sheets. Okay, just so that's fine. Okay, which of the following investments would be considered best based on their risk-return relationship? Assume all investors are risk adverse and they're held in a portfolio, in isolation, not in a portfolio. Okay, so all of them are separate. So here we need to work out CR, correlation coefficient. Not correlation or coefficient, coefficient of variation. Not CR, CV. Okay, let's just put a note here. Expected return, ER, standard deviation, coefficient of variation. Okay, coefficient of variation. Do you have the formula?
That's that whole...
Yeah, here's it. Coefficient of variation. Let's just see what we did here, just to make sure. It's standard deviation divided by expected return. That's it. Standard deviation divided by expected return. So, let's paste that there. Okay, what was my expected return for all of these? GHI. Okay, GHI. Expected return 10, 20, 10. 10, 20, 10. Standard deviation 7, 10, 9. 7, 10, 9. 0.09. Right, so standard deviation, this one. Divide by expected return, that one. Do that for all. Right, which is the lowest? That one. H is the best. H, because the coefficient is the lowest, 2. Makes sense?
Yes, it does.
Okay, good. 29. Rose's investment portfolio currently contains 2 types of assets that have a total value of that and that. Invested, okay, beta, okay, so there's that portfolio beta story, so it's a weighting story. Okay, so you've got beta, you've got the investment, okay, and you've got different assets. What assets here? A and B. A and B. Right, A's beta. A has a beta of 1.6. B has a beta of 3. A is 1.6. B is 3. How much do you invest in A? Two types of equaling value 2. 5,000 and 3,000. Oh, 500,000. 300 will be invested in A. So 300 in A and 200 invested in B. Right, so the total portfolio is obviously 500. Then you need a weighting. Okay, so...
Is that 50-50?
No, it's not 50-50. It's
No,
300 to 200.
What I checked in
Okay, normally it could be 50-50, but not always. Yeah, so it all depends. So brackets, 300 divided by that times that beta. Close brackets.
And then you do the same.
Then you do the same with this one. 200,000 divided by that times that beta. Okay, gives you that. You add those two amounts to get the portfolio.
2.16.
Portfolio beta equals this plus that gives you 2.16. Good, 3. You got the same answer,
Yeah,
eh?
but you got it 2 wrong.
Okay.
Only.
It's looking good.
So that's a good sign.
Yeah, very good. Okay. Right, here they're asking for market risk premium. Okay, market risk premium is market risk premium. The risk premium is the whole thing. The market risk premium is just the brackets. Okay, so it's the market return minus the risk-free. An asset has a beta of that, required return of that, market return is 12, risk-free is that, so it's 4. Option 2. Okay, so it's just the bracket part of the cap M. Okay. 31. A bond pays an 8% coupon semi-annual. That's PMT. Right, so 8% of what is the par? 1,000.
Par is 1,000, so that's a future value.
Okay, 8% of 1,000. Ooh, let's do that again. PMT equals 8%
of 1,000.
Of 1,000 is 80. Alright, it's semi-annual, so it's twice a year. Matures in 12 years. N is 24. 2 times 2. 12 times 2. Okay, the rate, it's currently selling for 875.40. Present value, yeah, it's selling for, so 875.40.
So we need the R.
875.40, is that right?
Yes.
What is the yield to maturity?
So
yes. So, I need to put in a FE here. I almost forgot that one, just to insert it. Just so you have everything there.
Yeah, that's going to have to be a negative. The PV is going to have to be negative.
Yeah, you have to make one negative so you get the right I. But remember, this will be I2. Okay, so let's work it out.
When you put it on the calculator, it just gives you the right answer.
No, it'll give you I2. Then you need to times it by 2. Okay, but let's check. N is 24. Payment is 80. Present value, negative 875.4. Future value, 1,000. Close brackets gives you 9%. Let's just move that across. Okay, 9.32. Times by 2 to get the yield to maturity, because that's half yearly. Okay, so times by 2 is 18.63. It's not here, so they actually haven't done it correctly. They should have times this by 2 because they asked for the rate, and this was semi-annual. Okay, so if you refer to one of the previous examples that we did, you have to take this, because remember, this is half yearly, that's half years, so the rate will be half yearly. Okay, if you want the yield to maturity, this is the correct yield to maturity. Okay, there should be errata for this question if they want to be accurate. But there's no other option, so then just choose 9.31. See, there's no even 9.31 here.
Yeah.
Okay, so there's errata with this one. You could, but yeah, there's a problem with this question. Oh, hold on. Hold on. I've made a mistake. Divide by 2. Half yearly. That should have been 40. See? Okay, this is semi-annual. I didn't put semi-annual here. Ooh, I've made a mistake. So it's not them, it's me. Okay, let's check. Let's fix it. Okay, so this will be not 80, this will be 40. Okay, there we go, that's better. 4.89 is there. Yeah, 4.89 is there, times 2 gives you 9.78. Yes, that's there. Okay, they've done it right. Okay, just be careful. Just use the semi-annual. Yeah, I needed to do semi-annual there. That was my initial error. Okay. Right, option 3. You got that?
Yes.
Okay, so you did right. That's good. Okay, 32. Current price of a 10-year bond, that's N. Par value, FE. That's the price, PV. Interest of this bond is paid every 6 months, half yearly. Yield to maturity, I2. 14 divided by 2. Let's put all that. Okay, I2 equals 14% divided by 2. Future value equals, what is the par?
Par is 1,000.
1,000. What is the PV? 1?
1158.91.
Okay, 1158.91. Alright, bond is paid every 6 months, 10 years. So N equals 10 times 2.
Yeah.
Okay, what is the annual rate of the coupon, basically? So we can work out the payment now. Solve for PMT. Let's see what we get. Equals PMT brackets. The rate here was 14 divided by 2 is 0.07. The N is 10 times 2, which is 20. The PV is negative 1158.91. The future value is 1,000. Close brackets. The payment comes out to 85. Because this is half yearly, let's just do a calculation for it. PMT equals the rate, or the coupon rate, times face value, divided by 2, because this is half yearly. Yeah. Okay, so 85 is the answer, gives you the rate times 1,000 divided by 2. Okay, so 85 times 2 divided by 1,000 gives you 17%. Good, option 2.
Some of these questions have been a little tricky.
Yeah, but you're getting them right. Yeah. That's fine.
A little bit harder than the previous papers.
Okay, alright, 33. Current rate of inflation, 6.5. The real rate is 3. And you have spotted an investment opportunity that pays 12. What is the risk premium associated with the investment? Okay, so remember, real equals nominal minus inflation, right? Okay, did they give you real? Yes. Did they give you inflation? Yes. So you can calculate nominal. Okay, so nominal equals real plus inflation. Okay, so nominal equals, what is the real? 3, and the inflation 6.5. So real is 3 plus 6.5 gives you 9.5. Okay, so equals 9.5. That's the nominal. You have spotted an investment opportunity that pays 12%. What is the risk premium associated with investment? So 12 minus 9.5. Okay, 12 minus 9.5 is, what is 12 minus 9.5? Is it 2.5? Sure. Okay. 2.5 is right. Option 1. Okay, 34. Let's have a look. Theory. Okay, which of the following implies an upward sloping yield curve? So let's draw a little upward sloping yield curve.
This has been asked before.
Yes, okay, so when the return on bonds with a higher default risk is higher than the return on the bonds with a lower default risk? No. When default risk, no. These are talking about default risk. When the return on long-term securities are equal to the return on short-term, no. When the return on short-term securities are lower than the long-term, yes. Did you get 4?
Yes, I did.
Good. Okay, it just relates the diagram, the picture.
Yeah.
Okay. Company A recently paid a dividend. Recently paid means div 0. Okay, so D0 equals 5 Rand. It is expected the company will pay a dividend of 6 Rand next year and 7 Rand thereafter. Okay, so I need to draw a timeline actually. This would be better. Okay, T0, T1, T2, T3, T4, T5, T6. Okay, let's build a timeline. Okay, the dividend that we paid at T0 was 5. Next year, the dividend is 6 Rand, then 7 Rand. 6 Rand, then 7 Rand. The company's dividend is expected to remain stable at 7 Rand thereafter. So 7 Rand, 7 Rand, 7 Rand, forever, never, never.
Yeah.
Oh. 7, 7, 7. Okay. The required return is 8%. So this is the first dividend that stays the same.
Yeah.
So PV
From T1.
0 equals div 1 over brackets R minus G close brackets. There is no growth. So PV 0 equals 7 divided by the rate, which is 8%, 0.08 equals. So this is going to give us a PV at time 1. Okay, so that's at time 1, because this would have been inverted commas T1. This would have been inverted commas T2, T0, and onwards. Okay, so use cash flow. Year 0 is 0. Year 1 is 6 plus 87.5, which is 87.5 plus 6, 93.5. The I here was 8%. Solve for NPV. Can you do that on your calculator quick?
So cash.
Let's see what you get.
The I is 8%. So it's going to be 0. And then 6 plus 87.5, 87.5. Escape.
Plus 6.
I did plus it.
Oh, you did add.
Yeah.
Okay.
Let me just make sure. But I did,
86.57.
Which gives you 93.5.
No. Well, yes.
Yes.
And
now
then,
I did do the R.
yeah, work out the
Yeah, now I'm doing
NPV.
the NPV.
Good.
Gives you 86.57.
Good. Did you get 2?
Yes, I did.
Good. Okay. 36. A had a price earnings of 10, a market price of that. They want to know what the earnings per share. So here's another ratio question. Right, so you go and you get your
Earnings per share ratio.
this one.
EPS.
What did they give you? Price earnings. Okay, let's copy that one first. And they gave you EPS.
Well, we need to work out EPS.
Okay, so yeah, so you need the formula. Let's write it down as well. Okay, so there they are. Let's write down the things that we know.
Okay, so
Price earnings
ratio
10, market price 50.
50.
Okay, price earnings 10, market price
is 50.
50. Oh, then that we don't actually need the other ratio. Okay, divided by EPS. Okay, just solve for EPS. That was actually quite an easy
so
one.
you're going to have to times it because you take it to the other side.
No.
Because it's being divided.
No, be careful. If I take that to that side, then it becomes EPS equals 50 divided by 10.
No, I was saying the 50 to that side.
Then it becomes times, but then it's 1 over EPS. See, then that's
Yeah.
okay, so it's 50 divided by 10.
It's
Okay,
5.
take that to that side, which is 5, yes. Option 1. Did you get that?
Yeah.
Okay. Doesn't matter which way you take it as long as you get the same answer. Okay, what is that? 36, 37. Okay, a share has an is expected to pay a dividend of that at the end of next year. Okay, at the end of the year. So that's div 1. The required return is that's the R. Constant growth, that's the G. What is the price? That's easy. Gordon growth. Okay, so PV equals div 1 divided by bracket R minus G. Close brackets. PV equals div 1, 0.75. 0.75 divided by, what is the rate? 12%.
The rate is 12.5.
12.5%. What is the growth?
The growth rate is 8.5.
0.085. Okay, let's copy that. answer 18.75. Same answer? 2. Good. Okay, 38. Which of the following equity holders would be last in line to receive their claim on assets in the event of business failure? Ordinary shareholders.
Yep.
3. 39. A, B. Shares are expected to pay a dividend of 6 rand per share forever. That's a perpetuity. Alright, it's currently selling for, that's the PV. What is the required return? So that's a perpetuity. PV equals payment over rate. The PV is 125.52. 125.52 equals, what is the payment?
The payment?
No, 6 rand, eh?
Yeah.
6 rand, so 6.
Dividend of
6
yeah.
divided by R. Okay, solve for R. R equals 6 divided by 1.52, 4.78.
Yep.
Good. Option 2.
100.
Yes. Okay, last one. A pref share pays an annual dividend. That never changes.
Yeah.
Investors require 16% return. It's another perpetuity type question. Copy paste. Okay, number 40. Right, so PV equals, or what do they want us to work out? The PV, hey, yes. So 4 divided by, PV equals 4 divided by 0.16.
Yeah. Gives you 25.
Gives you 25. Good. Option 2.
Yay, so I got like over 90%.
Yeah, for the multiple choice.
I got 38 divided by 40 times 100. I got 95%.
Out of the multiple choice.
Yeah.
That's brilliant. Well done. Okay.
Yay.
Section B, written. Right, so now we need to look at some written questions that cover different topics. Let's see what they were asked in this year. Okay, so question 1. Briefly describe the following theories of the term structure of interest rates for 6 marks. Okay, so they're looking at all of the different theories. Okay, so I'm going to give page references for this. Question 1A. Can I use your textbook just to give the page reference?
Thing that I googled.
Not a bad thing, but
Okay,
you
please.
should use what's in the textbook
Yeah.
because they're going to be testing that.
I didn't have my book then.
Expectations theory.
I did this at work.
See textbook page. Let's just look for it in the
I
index.
didn't bring this whole book with me.
Yeah, it's fine. It should still give you the same answer. Google should still give you a reputable reference.
Yeah, I didn't choose Wikipedia.
Okay. Expectations theory. Let's just see where we can find it here. Right, first time I saw they actually asked theory like this. So
Yeah.
you do actually need to know these things, eh? Expectations theory.
I actually like this though because
222. You like studying the stuff?
I
Okay.
do because I can get easy marks here.
Okay, good. Alright, so 222, you would write down what's on this page. Just to read it. The theory that the yield curve reflects investor expectations about future interest rates and inflation, and increasing inflation expectation results in an upward sloping yield curve, and a decreasing inflation expectation results in a downward yield curve. So expectations refers to
So it's
inflation.
222.
Triple two. Okay, maybe go over that before you write next
will
week.
do.
Liquidity preference, that's 1B. Okay, let's write that down. Liquidity.
This is in economics, liquidity.
Yes, because it looks at the term structure of interest rates and inflation.
And money supply.
Yes, it could also
It's a big thing with money
follow
supply because the
that.
more money you supply and the interest rate, if money supply increases, interest rate decreases.
Okay, this is on page
So-
223, sorry. Okay, just to read it, liquidity preference theory. Theory suggesting that long-term rates are generally higher than short-term rates. Hence, the yield curve is upward sloping because investors perceive short-term investments to be more liquid and less risky than long-term investments. Borrowers must offer higher rates on long-term bonds to entice investors away from their preferred short-term securities. Okay. Right, and then the last one, did they give you market segmentation? Yes, they did. So they asked all 3. Okay, that's okay, supply and demand one. Okay, you had a note about this in your textbook as well, or your notes. Okay, market segmentation theory. See textbook page. It's on page 223 as well. Okay, so just to read it.
Yeah.
theory suggesting that the market for loans is segmented on the basis of maturity, and that the supply and demand for loans within each segment determine its prevailing interest rates, and the slope of the yield curve is determined by the general relationship between the prevailing rates of each market segment. Okay, so straight from the textbook. Yeah, 100%. Okay, great, thanks. Okay, that's that. Alright, so it's pure theory. 6 marks for knowing theory. That's quite a bit, eh? Because it's out of 70. So 6 out of 7 is almost 10%.
It's a lot.
Okay.
Yeah.
6 out of 7 is almost 10%. Just for knowing 3 little sections. Okay. Alright, 1.2. Okay, this is broken up into different sections. So let's do it. 1.2.1. 1.2.1. 1. Okay. Alright, you have to make a choice between 2 bonds. K makes semi-annual payment at a maturity of that. So semi-annual is half yearly.
Yeah.
That's the N. Coupon rate is the PMT. D has a yield, that's the N. That's the PMT. Par value of each bond is 15. That's important. That's future value.
This is the first exam that we've done where we've actually had to do
Have
that.
a long question.
Yeah.
Okay, interest
That's a long
rates,
question.
that's the yield to maturity. Okay, determine the present value of bond K. So you're just working out price for bond K, which is what you've always done. Alright, so bond K, let's read it again. Bond K makes semi-annual payments. Maturity is 5 years. So you'd write N equals 5 times 2, which is 10 half years. Okay. I is 12.35%. Yeah, so I2 equals 12.35% divided by 2, which is, this I would show, hey, as an amount, because it's written. Only because it's written do I show every single answer. Okay, 12.35 divided by 2 would be that percent.
It's 0.06175.
Okay, what else do you have here? Coupon of 12.5%. So, PMT equals 12.5% of 15,000 divided by 2 equals. Okay, because it's half yearly. Alright, so 0.125 times 15,000 divided by 2 equals. That would be my payments. Okay, let's write down the future value given 15,000. Then I would write here, solve for present value equals. Okay, then I would just use my calculator. Present value equals the rates 0.06175. The N 10 half years. The payments 937.5. The future value 15,000. Close brackets. Answer 15,082.12.
I messed up. I'll show you alright.
Okay, you didn't use half yearly for the payments. Yeah,
I
so
did everything else
just the
except
half yearly for the payments. Okay, so you would have got maybe 1 out of 2 for that one. Okay.
I didn't know how to do the half.
Yeah, this is
but
out
now
of
I do.
this is out of 2, so you would have got 1 for that.
And I know
Determine
how
the
to do
present
that.
value of bond D. Okay, so 1.12.2. Okay, let's work out D's information. Let's go back. Okay, bond D has a maturity of 6 years, so N equals 6.
Yeah.
I would even write down years because you need to be specific if it's a written question. Okay, coupon rate 12.2%. PMT equals 12.2% of 15,000 equals.
This one I would have got.
Only because it's written do I show all of this. Times 15. Okay.
Yay.
Par value of the bond, FV. Copy paste. Rates 12.35%. I1.
I got 14,908.40.
Okay, let's have a look. N was 6. Present, no, payment. I need my payment. What is it? What is 1830? No, leave the payment and the future value the same. Okay, both positive. Okay, the answer will be negative. Right, so the value of bond D is that. Okay, so this is the value of bond K. this is the value or price of bond D.
And if I put the answer in a positive, will I get the mark?
No, yeah, the negatives you don't show
Okay.
when you write down answers.
Okay, I got the answer.
Yeah, okay.
I wasn't sure I was doing it right, so I wrote in pencil, so it's right.
Yeah, no, it's correct. Okay, that's for bond D. Alright, 1.2.3, 1.2.3. What is the relation that exists between the required return and the coupon interest rate when a bond is selling at a discount, premium, par? Okay, go copy paste my table and just write down everything. Bonds was chapter 5, I think. Let's see. Yeah, it was bonds, then shares, then revision. So it should be this group of notes. Yes, it is. Okay, and they want you to basically explain this table.
Yeah.
Okay, so I'm literally going to copy paste it because that's exactly what you're describing. Okay, but just in words. Okay, so it's not written nice. Let's do this. I want the nice picture. Okay. Right, so you're just going to be talking about this, that's all. Okay, but ignore my examples, obviously. Okay, I just related that to examples we did in the notes. That's what you're going to be discussing. Right, so for 3 marks, maybe just to say what I would be writing. Let me just close some of this. Okay, so the question said, that page, what is the relationship that exists between required return and coupon interest when a bond is at a discount, a premium, at a par? Okay, so I'm going to be talking about this. This is what is important. Okay, so this is what I would say. Right, when a bond is a discount bond, the coupon rate will be less than the discount rate or the required rate. That's all. Okay, then for this one, what would I say here? For a premium bond, the coupon rate will be greater than the discount rate. The discount rate you can replace with this, required return. See, in the question they used required return, that's referring to the discount rate. Okay, because the discount rate is the required return that you discount things back in time.
So if we say discount rate or required
use the word that they've given you. So use required return. So I would replace discount rate. Discount rate, let me just put a note here. Discount rate is the required return.
I knew what was going on. I didn't know that.
How to explain it. Yeah, but it's just theory. Okay. So it's 3 marks. So it's not too much to explain.
It's a mark for each one.
Yeah, and then the last one I would say, for a par value bond, the coupon rate must be the same as the required return for it to be at par. That's all. Okay.
That's simple enough.
Make sense?
Yes.
Okay, what else? Okay, another question. Well, it's quite a long question here. Nice splitting into different sections though. Okay, as a risk adverse investor, would you prefer bonds with short or long periods until maturity?
That's
Why?
reluctant to take risks, and I said a short term.
Good.
There are less risks involved.
For what? You can't just say less risk involved. You need to explain why.
Okay.
I'll give you one. If I was marking it,
Okay.
you would have to just explain what risk. What risk?
Interest.
Yes, there we go. Now you've got the 2 marks. Short-term bonds are subject to less interest rate risk. Brackets, because rates can fluctuate over time. Okay, you can write a whole long paragraph if you want to. If there's time in the exam, impress the examiner. So I mean, if you've got 2 hours and you've spent less time on the multiple choice because you're so good at the calculator, then write more. Write that and
then add more.
Just add an extra 2 notes,
It's
but
not gonna kill,
it's not going to hurt adding more. It'll help you, hopefully, because then they can see, oh, okay, there's no question, we're going to give you the 2 marks. Okay, don't give them doubts, basically. Let them tick it twice. Okay.
Hopefully I get a nice marker.
Yeah. Okay, question 2. Last one.
This is a long one.
Is it?
It's 2.5.
Okay.
2.5,
Yeah. Okay, 15 marks. It's a long one. Good. Alright, so, but it's all dividends. Still present value, time value, money, basically. But you need to draw diagrams, possibly. If it's written, don't be afraid to draw diagrams and show them what they're giving you. Okay, whatever I'm writing is what I would be writing, basically. Okay, determine the value of the cash dividends at the end of each year. Okay, so I know I'm going to have a timeline because at the end of each year.
T0, T1, T2, T3.
Yeah, I had a nice one earlier, so I want to copy that there because it was all centerized. Okay, paste.
So a T0 is 0.
Okay, let's read it and then let's see. Shoppers expects an irregular dividend pattern for several years and then growth at a constant rate. Suppose Shoppers Paradise has just paid a dividend of 225 per share and no growth is expected for the first year. So 225 would be here and for the first year, so there.
Okay, so I must put it there both. Okay.
Then the expected growth rate is 4% for the next 3 years.
Yeah.
Okay, for the next 3 years. So the next 3 years will be brackets 2.55 times 1.04. I'm adding 4%. Growth for how many years? For 3 years. So 4% growth. See, I'm showing it on my diagram. See, I'm showing this for how many years? 3 years. See, I'm showing the examiner for 3 years. Growth is 4%. Okay, because now if they've got the picture, they can see what I'm thinking.
Yeah.
Right, because I'm not going to be there when they mark my script. So I need to show them what I'm looking at in terms of the calculation. Right, so this times 1.04 gives you that answer. Okay, then you're going to copy that. 652. This times 1.04 gives you that. Then you're going to copy that. 75808. Okay, I don't round off workings, I only round off answers. Okay, so I would show all those decimals, even if this was a written question. Okay, times 1.04. Right, so I only round off answers. Okay, I leave the working as the working because that's accuracy. Okay.
Yeah.
Alright, so did we answer the question? Let's carry on reading. Then the expected growth rate is 4%. Okay, we read that. And finally, the growth rate is expected to be constant at 6% thereafter. Okay, then you write down here, thereafter, 6% constant. Okay, so obviously if it's 6% constant, I would even draw a little arrow here for that little section. Okay, and then I would show that working. So the working for that would be brackets 28684032 2 comma actually 2 comma 6886 sorry 8684032. Okay, times 1.06 close brackets. Okay, so let's work that out. This answer times 1.06 gives me that. Okay. Makes sense?
Yeah, no, I did basically.
Yeah, that's fine.
Yeah.
Okay, good. Alright, so let's answer the question. Determine the value of the cash dividends at the end of
Can I
each
put
year.
a R, with the answer?
Yeah, you must,
Okay.
because they're rands. You
Just
must.
making sure.
Yeah, so let me just summarize the answer. 2.1. Okay, I will write this down. Okay, but nicely.
No, we'll do this.
Okay, so I'm basically telling them exactly what I've worked out. Okay, I'll say the dividend at T1 is the dividend at T2, T3, T4, T5, all of it. 3, 4, 5, that's it, 5. Stop at 5. Okay, so Alright, so the first one equals, there's the dividend. Second one, there's the dividend. Third one, there's the dividend. Fourth one, there's the dividend. Fifth one, there's the dividend. That's it. Okay, I will just summarize. Because it's written, I'm telling them what the answer is after I've shown the working.
Okay.
Alright, so they can't doubt what I've done. Okay, that was for 4 marks.
Sounds good.
Okay, so happy with that.
Happy.
Okay, determine the present value of dividends expected during the initial growth period. Okay, so they want the present value of the dividends during the initial growth. Initial growth is where? Here. That's initial growth.
Oh, when it's orange.
Do you agree?
Yes.
Alright, so 2.2, initial growth would just be that. Then I would just write down this, that part of my diagram. Okay, and I need to calculate the PV for each of those dividends. Alright, so then I'll say for div 2, comma, the PV is, and then I'll show working. Okay, future value is 2.652. N is 2.
Oh, so is this all I have to do?
I is, yes, take it back. I is 9%. I is 9%. Solve for PV. Alright, so let's see what we get for that one. PV, brackets, the rate 0.09. The N2, the payment, no payment, 0. The future value, 2.652, close brackets, gives you that answer. Okay, then I would do that for year 3. So I'm going to copy all of this. Okay, so for dividend 3, I'm taking back 275,808. That's what I'm taking back. I'm taking it back for 3 years. Right, so let's insert 3 years. 3 is your N. And the dividend is now 2.75808. Okay, there's the next answer. Okay, now I took that dividend back. I want to highlight this. Right, so let's keep that in yellow. Let's make this in green. And then let's make that in purple. Okay, so then the last one. Copy paste. Okay, for dividend 4, the dividend is, let's write down that dividend, 2,8684032. Right, taking that back for 4 years at 9%. Okay, so type that into your calculator at 4 years. The dividend is 8684032. Gives me that answer.
Okay, now I understand.
Okay.
Because I don't know what to do here. Okay.
Yeah, so you just have to interpret their question. Right, so if I go back, their question said, present value of dividends expected during the initial growth. Alright, so what is the initial growth? 4% over the next 3 years. Right, those 3 need to be taken back.
Okay.
Makes sense?
Yeah.
Okay, let's see. 2.3, what do they want? Determine the value of the share at the end of the initial growth period. Okay, end, meaning at the end of your diagram. So, 2.3. Let's go back to our diagram. This one. See, because now you've looked at all, you just haven't looked at the last part. So, copy this whole thing. Just so I've got more workings just so you can see it. Oh, try that again. Copy. Okay, so I'm not looking at this. I'm looking at that. That's what they say. They say determine the value of the share at the end of the initial growth period.
Back to the present value.
Initial growth period. Okay, determine the value of the share at the end of the initial growth period. So where's the end? the end of the initial growth period. Does that make sense?
Does.
Okay, so this dividend is div 1. So PV0 equals div 1 over brackets R minus G close brackets. Right, I'm just going to put inverted commas here. This is your T1. I'm going to put inverted commas there. That's your T2, T0. Make sense? Okay, so the present value here, PV0, would equal 3.04050739 divided by open brackets. My rate here was 9%, 0.09. My growth was 6%, minus 0.06, close brackets equals. Undo. Ooh, lost all of that. Let's try it again. PV0 equals
3040.
Yeah, that's fine, I got it.
Okay.
There. Okay, equals, paste, answer, there. 101. Okay, so 2 marks for that.
Is it going to be R101?
Yeah, well, rands.
Okay.
Everything in rands because it's the amounts, yeah. Okay, make sense?
Yes.
Okay, so in that question they talk about the end of the growth period. There's the end. Right, so now you can see 2.2 looked at this, which is that part.
Yeah.
2.3 looked at that.
Okay.
The last question is probably working out the price.
I didn't know what to do here.
Okay, which is everything basically.
No, I understand.
Okay, so 2.4, determine the present value of the share after the initial period. Present value, this is actually a repeat question. Oh, this is at the end of the initial growth period.
So that's where we have to do the PV, the
Oh,
FE,
okay,
the
so they want us to work out the present value of the share after the initial period.
What's the initial period?
Initial
After
period
that.
probably means that, I would think.
Okay.
Okay. And then determine the sum of all the present values. Oh, okay. Present value of the share after the initial period. So if they want the sum of all the present values, then the only one that we haven't summed up is this one.
So it is that one.
Because have a look. Let's copy this diagram again. Copy. Paste. Okay, this we've calculated.
Yes.
That we've calculated.
It's only T1 we haven't.
Exactly. So
And
that
it's for
would
2
be...
marks, so makes
Yeah,
sense.
so that would be what they would need, because you need all of it. I'll show you the summary just now. Okay, so FV equals 2.25, N equals 1, I equals 9%. Solve for PV. Okay, PV brackets, the rate 0.09, the N 1, no payment 2.25. Let's make it negative so you get a positive answer. Okay, answer 2.34.
Okay, that makes sense.
Okay, then the last step, 2.5, is asking you for the sum of all the present values. So you're basically working out, so calculate, no, not all of them, you'll see what I mean. Calculate the PV, which is the price of the share at time 0. Okay, look at this. Okay, let's copy this. Let's paste it. Okay, so I need the PV of T1. Do I have that? Yes. PV of div1 equals, let's write that down. PV of div1 is my answer from 2.4. There's the one answer. From 2.4. Okay. Then I need div2, div3, div4. So let's just copy this. 2, 3, 4. 2, 3, 4. Okay, so the present value of div2 I've worked out already. Okay, let's go up. Where did I work it out? Here's it. There. PV of div2 is this amount. See, this is from 2.2. There's the amounts. Okay, from 2.2. Copy, paste, paste. Okay, PV of div 5 growing constantly. That one you need to work out. Okay, so the present value of div 5 growing constantly, I need something. There's it. Here, there's the constant growth model. Remember this thing?
Yeah.
Okay, where is this sitting? At time 4.
Oh, okay.
Because remember, it's
That's
T0 and T1. Okay, so I need to discount that back in time. So I'm going to take this, copy, paste that there. Okay, so this one we need to calculate. So I'm just going to show that. Let's show a little arrow. Copy, paste. Come, paste the arrow. Okay, I just want to show this. Back to there. Alright, so PV of div 5. Oh, I've got that already. Okay, I just need to show the working. Equals. Maybe I should show the working. Let me just show it here. Future values, just so you know what I'm doing. 101.35. N is 5. I is 9. Solve for PV. Okay, which is PV brackets 0.09 N 5, no payment, that amount is your future value, close brackets equals there, that answers. Then I would put that here, 65.87.
So we must do for every single one.
Let's just copy it, equals there. Let's make it positive. Alright, then you need to add up. Okay, so sum up. Sum up the divs. This plus that plus that plus that plus that gives you that answer. Okay, have a look at this. Check it with the cash flow shortcuts. Okay, have a look at my shortcuts. Year 0, year 1, year 2, year 3, year 4, year 5. Okay, year 0, 0. Year 1, year 1 is this one. Year 2 is that one. Year 3 is that one. Year 4 is that one. Year 5 is this amount. Oh, no, year 4 actually. It's only 4. No, 5. 5 is the one that grows constantly.
2.652
plus that.
3 is 2.
Okay, brackets. 2.868432 plus 101.35. I equals 9%. Solve for NPV.
I got 80.53.
Hey?
I don't know if I did wrong.
Let's check. Go up to your cash. 9% is right. 0, 2.5, 2.265, 104.219. Yes. Maybe I made a mistake somewhere. Let's just check. This I discounted, that I discounted, that I discounted, that I discounted. 5 we didn't discount, but we worked out that. And that was sitting at time 4. So, this should have been, this one's wrong. Not 5, this should have been 4.
Okay.
Sorry, that should have been a 4, not a 5. Okay, it's at time 4. Okay, there. See?
So that is 17.
What is your NPV? 80.53 there.
Yeah.
See, now it's right. See? Look.
Yeah.
Okay. So if you solve for NPV, you get that same answer.
So it must be 71.80 just for div 5.
So that needs to change. Yeah. So just that needs to be that, and that's the right answer. Same as that.
Okay, now at least I know what's going on there. Because I was a bit confused.
Yeah. So that was just discounting it back in time, but in steps. Was that the last question?
Yeah.
That was 2.5. How much is that out? 15. That's a big one, eh?
That is a big one. That's why I was a bit unsure.
Yeah. So it's just the one diagram, but you're discounting it back in sections.
But now I understand.
Yeah.